Hello everyone, welcome to the 173rd episode of Be Learning How to Trade in the Forex. In Forex. In the last episode, we went through the pros and cons of fundamental analysis. So, the pros of fundamental analysis is that it can help you identify long-term trends. So, technical analysis generally only identifies short-term patterns and opportunities. Using fundamental analysis will highlight companies worthy of longer-term investment. So, this might suit you better if you're patient and prefer not to incur repeated dealing charges. Fundamental analysis can also help you spot value stocks. So, solid fundamental analysis can enable you to identify companies whose share price undervalues or overvalues their real worth. So, investment in companies like this is known as value investing. It can also help you develop your business acumen. So, by carrying out a comprehensive analysis of a number of companies, you'll build up a thorough understanding of the way these businesses work, getting to know their industry sector and what drives their revenue and profit. So, this can be invaluable as it helps you recognize which companies to avoid and when it's the right time to enter or exit a position. So, as you become more familiar with studying balance sheets and income flows, you also get a sense of the varying levels of volatility and risk that apply to different companies and sectors. So it also helps you to categorize shares correctly. So business is constantly subject to change. Companies can rise to success or fall from grace as their environment evolves. So understanding the company's business gleaned through fundamental analysis can help you categorize it correctly as a well-managed, well-resourced entity that's positioned to flourish in a changing environment, or a flawed, inflexible organization that will struggle to adapt to the shifting competitive landscape. So this will help you work out its relative value in the position in the face of changes within the industry. However, the weakness of some fundamental analysis we can see is that it can take a long time to pay off. So while it does help you identify companies that have might been overpriced or underpriced, it won't necessarily reveal the likely timescale before the share price moves in that direction. So unlike technical analysis, where the moment to buy or sell can often be predicted on the chart, there's no way of knowing how long it might take to secure a profit when using fundamental analysis. No two sectors are the same, so the way you assess a company's value will depend on the sector it belongs to. So each time you look at a new company in an unfamiliar sector, you probably need to use a different approach altogether. So this means that for the interest of time, you may need to restrict yourself to just one or two sectors. Objectivity can be impossible. So when calculating the fair value of a company, you often have to make assumptions about the variable factors such as interest rate expectations, government taxation policy, but these assumptions are by nature entirely subjective, so basically opinionated. The most you can do is consider multiple scenarios and outcomes to allow for the fact that your view may be overly optimistic or cynical. Companies also spin their own news, so most of the information fundamental and analysts use to assess a company comes from the company themselves. So they could hire investor relation managers to ensure any release reflects as positively on their performance as possible. So it's worth bearing this in mind and taking their announcements with a pinch of salt. So basically don't trust it entirely. And then we went through a lesson summary. So we left off with the quiz last time, which we're going to start off with doing. So the objectivity of a fundamental analysis is to identify little known assets that are rarely traded, assets trading at a price that differs from their real fair value, highly volatile assets suitable for short-term trading, stable secure assets are unlikely to move dramatically. I think it's assets trading at the price that differs from their real fair value, so whether they're underpriced or overpriced. Which method do most fundamental analysts tend to use? Top-down approach starting with the wider picture? Yes, top-down approach. So from the economy, sector, and then company, I think. Which of these factors could be a red flag indicating difficulties that might affect the company's future share price? Competitor has recently released an innovative product. Country where the company operates has reported poor economic data. There have been some abrupt changes in the executive team. Members of senior management have been reducing their shareholdings. All answers are correct. Which industry sector is more likely to offer stability for share traders when an economy is shrinking? Utilities. Because you still got to pay for utilities even if the economy is bad, so utilities. What does a company's balance sheet show? Assets, liabilities and capital. Why might you calculate a company's debt-equity ratio? To measure its financial leverage. What does it mean when a company is described as having high quality earnings? Generates revenue by selling luxury goods. It has shown consistent profits for the last 5 years, for at least 5 years. Its cash from operations is higher than its net income. Has very little debt. Cash from operations is higher than its net income. Which of these describes an income statement? Counting scorecard illustrating future profitability. Formulas calculate company's cash holdings. Calculation to forecast revenue for the next 5 years. Declaration that revenue is from legitimate sources. I think it's the first one. Counting scorecard illustrating future profitability. Which of these are not benefits of using fundamental analysis? Not benefits. Helps you identify long-term trends. That's a benefit. Develops your business acumen. Benefit. Gives you deeper understanding of chart data. No, it does not. Helps you spot value stocks. Benefit. It's a good way to ensure fast profits. Not benefit. A company's share price is equal to its market capitalization divided by the shares issued. Yep. Hey, nice. So, fundamental analysts believe that every asset has a real fair value towards which the price will naturally gravitate. They look for assets that appear to be trading at a higher or lower value than they should be, aiming to capitalize on this by trading before a price correction occurs. So, unlike technical analysis, which focuses on price data and patterns, fundamental analysis takes a holistic view of the circumstances surrounding a market. Analysts usually begin by looking at the wider economic picture before drilling down into industry sectors. Finally, they study individual companies within these industries in detail. There are multiple factors to consider when assessing the health of a company, both in its external environment and its internal operation and management structure. None of the above scenarios would necessarily imply trouble for a business. For example, a competitive innovation might spur the company to develop a superior product of its own. However, it's important to consider things like this when you form your final opinion. Energy and utilities business tend to be least affected by changes in consumer spending power. Even in an economic downturn, people always need to light and heat their homes, making phone calls and so forth. However, they're likely to cut back on entertainment, travel and buying gadgets or luxury goods. Shares of companies in these sectors could take a hit. A balance sheet gives you a snapshot of the company's assets, liabilities and capital at the end of a particular reporting period. So the debt-equity ratio is calculated by dividing the company's liabilities by its shareholder equity. This gives you a picture of the level of debt in the business. A high ratio could indicate that the company is financing ambitious growth plans, but also that it may be liable for substantial interest expenses with increased exposure to risk. So, if the figure for a company's cash from operations is higher than its net income, this indicates a high, substantial proportion of its earnings are being converted into cash. In other words, it implies that the company is operating efficiently. A company's income statement measures its financial performance over a set period. It compares the value of sales made, which is revenue, with the cost of making them, expenses. If the revenue earned from sales is less than the expenses incurred to make them, then the company's business model is likely to be flawed and its future profitability is questionable. Fundamental analysis complements technical analysis, which focuses on chart data by assessing all the other factors affecting an asset's value. It can help you get a deeper understanding of how businesses work and so to spot companies that have potential. In general, it's most useful for longer term traders and investors, since you don't usually predict a timescale before price movement is likely to occur. Company share price is equal to each share. Each share is a stake in the overall value of the business. It's market capitalization, so dividing the market cap by the number of shares gives you the share price. Yep. Cool, so that was fundamental analysis done. Now we're on to using trading and investment products. So buying and holding shares is often seen as a stepping stone towards more actively managed wealth building techniques. It's a sensible and straightforward way to grow your assets over time. However, making shorter term strategic decisions can help you accurately or accelerate your wealth building journey. Protect the assets you already own and manage your tax liability. In this course, we'll explore some of the ways you can use different products to grow your wealth. You'll also learn about the risks and benefits involved. Since this strategy, sometimes referred to as a multi-product or core satellite strategy, is normally used by more experienced market participants, it's important to have a firm grasp of the basics. A strong foundation may help reduce the risks that could be introduced by using more than one financial product. If you haven't already done so, you may want to revisit our course on how trading works. Yep. So, what are financial products? So, what are financial products? We gain access to financial markets using financial products and instruments. You may have already been familiar with some of them: savings, government bonds, mutual funds, individual shares, and exchange traded funds, ETFs are all examples of financial products. Nice colourful diagram. Financial products can be grouped into two main categories: complex and non-complex. So, financial products can be grouped into two main categories: complex and non-complex. Non-complex financial products are better suited to beginner traders who don't yet have much specialist knowledge. For example, buying and selling shares is a straightforward practice that most people can understand, so it's considered non-complex. So, non-complex financial products are better suited for beginners who don't yet have much specialist knowledge. For example, buying and selling shares is a straightforward practice that most people can understand, so it's considered non-complex. You can also access the markets using complex financial products. These let you benefit from the rising or falling prices of an asset without having to own it. So, complex financial products lets you benefit from the rising or falling prices of an asset without having to own it. They're considered complex because they aren't likely to be understood by the average market participant, like leveraged derivatives. For example, spread bets or contracts with differences are complex products. They're called derivative instruments because the value we unlock when using them is derived from the price movement of the underlying assets. And unlike the more traditional solutions like buying shares in a company, derivative trading requires a smaller initial investment for full exposure to the market due to leverage. Whereas like shares is just you have to pay up front whatever the shares cost. You can't use leverage, I don't think. Okay. Derivatives trading involves speculating on the price movement of financial assets using instruments such as spread bets and CFDs. These assets include company shares, currency pairs, indices, commodities, and cryptocurrencies. Oh, you can do shares. Okay, never mind then. You trade derivatives by going long when you think the value of an asset will rise, or going short when you think it will fall. Any profits or loss you make will depend on which way the market moves by and by how much. Derivative products can be incredibly powerful wealth building tools. They can amplify your returns and it generally takes less time to make a profit. However, it's important to be aware of the risks involved in leveraged trading. While it can magnify your profits, any losses you make are amplified in the same way. Similarly, rapid market movements or market volatility may help you gain profits in a short amount of time, but losses can happen just as quickly. Leverage trading can amplify your profits and losses. Market volatility may help you gain profits in short amount of time, but losses can happen just as quickly. Derivatives also allow you to protect yourself against losses from falling share prices through practices such as hedging and diversification. We'll explore how these work later on in this course. So lesson summary. We can use financial products to access the financial markets. They can be grouped into complex and non-complex instruments. Non-complex financial products don't need specialist knowledge as they're more simple to comprehend, whereas complex products require a deeper understanding of how they work. The price of a derivative product is drawn from the price of the underlying asset. If the real value of the underlying asset increases or decreases, its trading value also rises or falls respectively. The price of derivative products is drawn from the price of the underlying asset. If the real value of the underlying asset increases or decreases, its trading value also increases or decreases respectively. You can make profits from trading derivatives quickly because of the market volatility. However, any losses can be just as rapid. Leverage trading gives you full exposure to the market you're trading for a fraction of the cost it takes to make the trade. While leverage can amplify returns, your losses can be more than the amount you initially put into the trade. Market volatility can help you make a lot of money on a trade, but losses can happen just as easily. Yep. So, combining trading and investing. Combining trading and investing. When starting a company, having a well-researched business plan in place is the first step to achieving success. This plan will consider any challenges you might encounter in the future as well as potential remedies should those challenges come to pass. Similarly, when you start combining trading and investing for the first time, it's best to write down a formal strategy. So, when starting to combine investing and trading for the first time, write down a formal strategy. Creates a framework that allows you to monitor your progress as a trader. You can use a strategy developed by someone else or come up with your own to test in the market. This will help you measure the impact of your decisions, keep you from acting impulsively, and help you generate enough data to see whether your plan is working. So this will measure the impacts of your decisions, keep you from acting impulsively, and help you generate enough data to see whether your plan is working. Some market participants who trade multiple products use a core satellite strategy. So some market participants who trade multiple products use a core satellite strategy. At the heart of the portfolio sits a range of long-term financial assets. These assets are often a mix of shares, bonds, cash, and other alternative asset classes such as gold, commodities, and property. They're carefully selected and spread out methodically to help reduce your overall portfolio's risk. This is known as creating your strategic asset allocation. At the heart of their portfolio sits a range of long-term financial assets. These assets are a mix of shares, bonds, cash, and other alternatives assets such as gold, commodities, and properties. They're carefully selected and spread out methodically to help reduce your overall portfolio's risk. They're carefully selected and spread out methodically to help reduce the overall portfolio risk. This is known as creating your strategic asset allocation. So this is known as creating your strategic asset allocation. This core portfolio is held for years or even decades. The expectation is that it will provide investors with positive returns over the long term, along with income and dividends that can be reinvested back into the portfolio. So this core portfolio is held for the long term. The expectation is that it will provide investors with positive returns over the long term, provide investors with positive returns over the long term, along with income and dividends income and dividends, which can be reinvested back into the portfolio. Over time, the economic landscape as well as the valuations of each asset class may change. For instance, growth prospects in a country may make company shares from that country more attractive, and this may give you the opportunity to allocate more funds to these types of shares in your portfolio. This is known as tactical asset allocation. So, tactical asset allocation is allocating funds which assets, how do I describe this, which risen value, risen growth is allocating tactical asset allocation is allocating funds to assets which rise in value due to the change in the economic landscape and the valuations of each asset class. The satellite part of the strategy will usually involve introducing investments with a higher degree of volatility or price fluctuations. You can do this by buying speculative individual shares or funds, or by trading using derivative instruments. So, part of this strategy will usually involve introducing investments with a high degree of volatility, or price fluctuations. Can do this by buying speculative individual shares or funds, or by trading using derivative instruments. Did you know a speculative share is a stock from a company with value that's prone to high levels of volatility? This is usually because the company is young, its revenue and earnings growth might be unpredictable, or it's part of a risky industry, but it still has high growth potential. Because these companies are characterized by greater risk with the possibility of high returns, many market participants prefer to trade them on short-term basis. However, a long-term investor could also capitalize on a stock's low initial value and sell should the company grow. A speculative share is a stock from a company with a value that's prone to high levels of volatility, as the company could be young, its revenue and earnings growth might be unpredictable, or it's part of a risky industry. But it still has high growth potential. However, it still has a high growth potential. Because these companies are characterized by greater risk with the possibility of higher returns, many market participants prefer to trade them on a short-term basis. However, a long-term investor could also capitalize on the stock's low initial value and sell should the company grow. Smart money management is key to succeeding when using this approach. It's important to ensure that you make the distinction between money that's earmarked for building wealth and money that's used for speculative purposes. Ensure the money is managed smartly to make ensure the money is managed smartly. Make the distinction between money that's used for building wealth and money that's used for speculative purposes. Using a multi-product strategy. A multi-product trading strategy involves using a combination of investment assets like shares and derivative instruments like spread bets and CFDs to build wealth and manage your risk. So, a multi-product strategy involves using a combination of investment assets like shares and derivative instruments like spread bets and CFDs to build wealth and manage your risk. Buying shares gives you direct ownership in a company. People who buy shares often do so in the hopes that the company will grow in value over time so that they can sell the shares at a higher price later. This is called investing. You can also buy other types of securities such as ETFs or exchange-traded funds, which trade just like a share. The main difference is that those funds spread your investment over a large number of stocks or bonds. Investing, buying shares in a company, in the hopes that the company will grow in value over time so that they can sell their shares at a higher price later. You can also buy other types of securities such as ETFs, which trade just like a share. The main difference is that these funds spread your investments over a large number of stocks or bonds. So, exchange traded funds also trade like shares. However, these funds spread the investments over a large number of stocks or bonds, over a large number of stocks or bonds. A diversified portfolio can be a wonderful wealth creation tool, but it takes a great deal of time and money for it to grow. Because share prices typically rise over long periods of time, you build wealth by holding onto shares for years or even decades and possibly reinvesting the dividends. A diversified portfolio takes long time and money for it to grow. Because share prices typically rise over long periods of time, you build wealth by holding onto shares for years or even decades and possibly reinvesting the dividends. As share prices takes a long time to rise, you hold on to it for years and possibly reinvest the dividends. Using derivative instruments allows you to take advantage of shorter term price movements. With leverage, you only need a fraction of full shares full price to buy it, but with the added risk of losing more than your initial investment. Shorter term speculation on the price movements of financial instruments is called trading. Trading short term speculation of price movements on the price movements of financial instruments. Remember, when you trade, you can either take a long position when you think the value of the asset you're trading will rise, or a short position when you think it will fall. Going long equals hoping the asset will rise in value. Going short equals hoping the asset will fall in value. For example, a company making a surprise announcement in the wake of a scandal concerning one of its top leaders could scare off a few investors and thus drive down share price. For a derivatives trader, however, this situation could present an opportunity to take a short position of the company's stock to profit from its potential downturn. Did you know? Major economic, political, environmental events are known to cause volatility in the financial markets. In fact, keeping on top of the current events is important for a derivatives trader as it could give an indication about the near-term direction of a particular asset. So, hoping the asset will fall in value. So, major economic, political, and environmental events are known to cause volatility in the financial markets. Keeping on top of the current events is important for a derivatives trader as it could give an indication about the near-term direction of a particular asset. Keep up with the current events to give an indication of the near-term direction of a particular asset. Here's a quick exercise to check your understanding. ABC plc, a popular laptop manufacturer, recently launched a new and more advanced laptop model. Sales of the model has been doing incredibly well, and as a result, the company's stock price has been rising rapidly. You want to lock in the current price before it rises any further and potentially make a profit from its near-term movements. While doing your due diligence, you find out there's a growing microchip shortage that's affecting production of many of the company's products, including a newly launched model. You think this will significantly affect the company's bottom line in the near future, so you go long or go short. So there's a growing microchip shortage that's affecting the production of many of the company's products. So that means the microchip shortage affects the company's products as the company won't be able to produce enough to be able to keep up with the demand, right? If the company won't be able to produce enough to keep up with the demand, what does that mean? That means it won't be able to make much profit compared to how if it was able to keep up with the demand, right? So if it can't make enough profit to be able to keep up with the demand, that means, no wait, yeah, so if they can't make enough profit, that means the company's value isn't going to rise because they're not profiting enough. So if the company's value isn't going to rise and you think it's going to fall instead, that means it's time to go short on ABC PLC. You go short because the microchip shortage could adversely affect the company's profits. Yep. In turn, shareholders may choose to sell their stake in the company to avoid any future losses. This would lower its share price and subsequently its trading price. So if the share price falls in your favor, you'll make a profit. Remember, several factors can influence the price of a share, so negative findings like these in our exercise might not always have this effect on a stock's price. It's also not possible to know when a so-called price squeeze might begin. Traders have to keep their fingers on the pulse of any market or company movements. Remember that several factors can influence the price of a share. It's also not possible to know when a so-called price squeeze might begin. Traders will have to keep their finger on the pulse of any market or company movements. Price squeeze. Price squeeze. A multi-product trading strategy is a good way to add variety to your portfolio. Multi-product strategy is a good way to add variety to your portfolio because it combines less risky long-term investments with shorter-term volatility. You can find opportunity in various market conditions as it combines less risky long-term investments with short-term volatility. You can find opportunity in various market conditions. A multi-product strategy. Let's a summary then. A multi-product strategy combines complex and non-complex financial products to create a diverse portfolio. Buying shares is generally ideal for long-term investments, while trading derivatives can be useful for short-term opportunities. Trading with leverage enables you to amplify your earnings, but your losses could be just as amplified. Yep. I'm going to leave this episode here then, so in the next video we're going to go through understanding volatility and risk. So thank you all for watching, and I will see you guys in the next video, episode, lesson. Bye bye.